Are you feeling overwhelmed by credit card debt? Does it seem like no matter how much you pay, that balance just won't budge? Well, you're not alone, and more importantly, you're not out of options. In this comprehensive guide, we're going to dive deep into the world of credit card debt forgiveness. We'll explore strategies that could potentially wipe thousands off your balance, discuss support options you might not even know exist, and give you the tools to take control of your financial future. So, whether you're dealing with a few thousand or tens of thousands in credit card debt, you're in the right place. By the end of this article, you'll have a clear roadmap to tackle your debt head-on and come out on top. Before we jump into forgiveness strategies, let's take a moment to understand why credit card debt can be so problematic. Credit cards often come with high interest rates, sometimes upwards of 20% APR. This means that if you're only making minimum payments, a significant portion of your payment goes towards interest rather than reducing your principal balance. It's like trying to fill a bathtub with the drain open. You're working hard, but not making much progress. This cycle can lead to feelings of hopelessness and stress. But remember, you're not alone in this struggle. According to recent statistics, the average American household carries about $6,270 in credit card debt. So, if you're feeling overwhelmed, know that many others are in the same boat, and there are ways to turn things around. Now, let's talk about what we mean by debt forgiveness. It's important to understand that complete forgiveness of credit card debt is rare, but there are several ways to reduce your debt significantly. Debt forgiveness can take many forms: debt settlement, negotiating with creditors to pay less than what you owe; debt consolidation, combining multiple debts into a single, more manageable payment; bankruptcy, a legal process that can discharge some or all of your debts; and hardship programs offered by credit card companies for customers facing financial difficulties. Each of these options has its pros and cons, and we'll explore them in detail throughout this article. Our first strategy is one that many people overlook: direct negotiation with your creditors. You'd be surprised how often credit card companies are willing to work with you if you're proactive. Here's how to approach this. First, gather information. Before you call, know your account details, how much you owe, and have a clear idea of what you can realistically afford to pay. Second, explain your situation. Be honest about your financial hardship. Whether it's job loss, medical bills, or other circumstances, help them understand why you're struggling. Third, ask about hardship programs. Many credit card companies have special programs for customers facing financial difficulties. These might include temporarily reduced interest rates, waived fees, lower minimum payments, or payment deferral. Fourth, request a settlement. If you have a lump sum available, you might be able to settle your debt for less than you owe. Start by offering around 30% of your balance and be prepared to negotiate. Lastly, get it in writing. If you reach an agreement, ask for it in writing before making any payments. Remember, persistence is key. If the first representative you speak with can't help, politely ask to speak with a supervisor or the hardship department. And don't be discouraged if your first attempt doesn't work. You can always try again in a few months. If negotiating on your own seems daunting, you might consider working with a debt settlement company. These companies negotiate with creditors on your behalf, aiming to settle your debts for less than you owe. The pros of debt settlement include potential for significant debt reduction, a single monthly payment to the settlement company, and the possibility of avoiding bankruptcy. However, there are also cons to consider. Fees can be high, typically 15 to 25% of the enrolled debt. It may negatively impact your credit score. Creditors may still attempt to collect or even sue, and forgiven debt may be taxable as income. If you're considering this option, here's what to do. Research thoroughly. Look for companies accredited by the American Fair Credit Council or the International Association of Professional Debt Arbitrators. Understand the process. Typically, you'll stop paying creditors and instead make payments into a dedicated account. Once enough funds accumulate, the company negotiates settlements. Be aware of the timeline. Debt settlement usually takes 2 to 4 years to complete. Know the risks. Your credit score will likely drop, and there's no guarantee that all creditors will agree to settle. Consider the tax implications. The IRS generally considers forgiven debt as taxable income. While debt settlement can be effective, it's not without risks. Make sure you fully understand the process and consider consulting with a financial advisor or credit counselor before committing. Sometimes what you need most is expert guidance. This is where credit counseling comes in. Non-profit credit counseling agencies offer free or low-cost advice to help you manage your debt. Here's what you can expect from credit counseling: a comprehensive review of your financial situation, help creating a budget, advice on managing your debts, and information about various debt relief options. One powerful tool that credit counseling agencies offer is a debt management plan, or DMP. Here's how it works. The agency negotiates with your creditors to reduce interest rates and possibly waive fees. You make a single monthly payment to the agency, which then distributes payments to your creditors. Most DMPs aim to have you debt-free in 3 to 5 years. The pros of a DMP include lower interest rates, a simplified payment process, potential waiver of fees, and minimal impact on credit score compared to debt settlement. The cons include typically needing to close your credit card accounts. It may take 3 to 5 years to complete, and there are small monthly fees to the credit counseling agency. To find a reputable credit counseling agency, look for one certified by the National Foundation for Credit Counseling or the Financial Counseling Association of America. Remember, initial consultations are usually free, so don't hesitate to reach out for help. Now, we need to talk about bankruptcy. It's often seen as a last resort, and for good reason. However, in some cases, it might be the most appropriate path to debt relief. There are 2 main types of personal bankruptcy: Chapter 7, which can wipe out most unsecured debts, including credit card debt. But you may have to give up some assets in Chapter 13, which involves a repayment plan over 3 to 5 years, after which remaining eligible debts may be discharged. You get to keep your assets but must have a regular income. Bankruptcy is a serious decision with long-lasting consequences. Here's what you need to consider. The pros of bankruptcy include providing a fresh start by eliminating most unsecured debts, stopping collection efforts and lawsuits, and preventing wage garnishment and utility shutoffs. The cons include severely damaging your credit score for up to 10 years, potentially requiring you to give up some assets in Chapter 7. Not all debts can be discharged, e.g., most student loans, recent taxes, and it can make it difficult to obtain credit, rent an apartment, or even get certain jobs. If you're considering bankruptcy, it's crucial to consult with a bankruptcy attorney. They can help you understand if you qualify, which type of bankruptcy is appropriate for your situation, and guide you through the complex legal process. Earlier, we mentioned hardship programs when discussing negotiation. Let's dive deeper into these programs, as they can be a lifeline if you're facing temporary financial difficulties. Many credit card issuers offer hardship programs, also known as assistance programs. These are designed to help customers who are struggling due to circumstances like job loss, medical emergencies, natural disasters, or other unexpected life events. These programs can offer temporarily reduced interest rates, waived fees, lower minimum payments, or payment deferrals. To explore this option, call your credit card company's customer service line, ask specifically about hardship or assistance programs, be prepared to explain your situation and provide documentation if required, and understand the terms, including how long the program lasts and how it might affect your credit. Remember, these programs are typically short-term solutions. They're meant to help you get back on your feet, not as a long-term debt management strategy. While not technically a form of debt forgiveness, balance transfer credit cards can be a powerful tool in your debt-fighting arsenal. Here's how they work. You apply for a new credit card offering a low or 0% introductory APR on balance transfers. If approved, you transfer your high-interest credit card balances to this new card. You now have a period, typically 12 to 21 months, to pay off your debt without accruing additional interest. The pros include saving significant money on interest, consolidating multiple payments into one, and providing a defined timeline to pay off debt. The cons are that it usually requires good to excellent credit to qualify, often comes with a balance transfer fee, typically 3 to 5% of the transferred amount, and the low intro rate is temporary. Any remaining balance after the intro period will be subject to the regular APR. To make the most of a balance transfer, look for cards with the longest 0% intro period you can qualify for. Calculate whether the money you'll save on interest outweighs the balance transfer fee. Make a plan to pay off the entire balance before the intro period ends. And avoid making new purchases on the card, as these may not be covered by the 0% rate.